Hey guys, it's Quinn here from Lendi, and today I'm with Sam Hyman, Head of Inside Sales at Lendi, and we're going to talk about the ways to reduce tax on your investment properties so that you don't have to pay more than you need to. We'll go through negative gearing, the tax deductions that you're eligible for, and more. So welcome back to our channel, Sam.
Thanks very much.
Let's dive right into it. So one of our most spoken about techniques to reduce tax is negative gearing. Sam, could you tell us more about how that works and what the potential tax savings might be?
Yeah, sure. So quite simply, I guess, negative gearing refers to when your mortgage payments and property expenses actually outweigh the income that you receive from your property. So this can often sound like a negative thing, but it can actually be used to an investor's advantage. And this all, I suppose, needs to be in line with your investment goals and your investment strategy. So you can use this to minimize your taxes, as the losses that you make with a negatively geared property are tax deductible and actually reduce your overall taxable income. So on the other hand, I suppose with a positively geared property, which is where your rental income exceeds the expenses, it gives you a positive cash flow, which will actually increase your overall taxable income, meaning that you'll pay more in tax on a positively geared property. So I suppose it really depends on your overall investment strategy. And if your goal is to create a passive income, avoid negative gearing where possible.
That's pretty interesting. So regarding the tax deductions, obviously you can claim tax deduction on the interest charge on an investment home loan. Could you also tell us more about the other ways that investors can use to claim tax?
Yeah, sure. So you can claim 100% of your interest payment as deductions. And that's also why some investors choose to have an interest-only home loan repayment. Basically, that allows them to take advantage of an interest expense that will not reduce because the principal's not being paid down. So the other really important point to consider there is the property must be rented out or genuinely available for rent in the income year that you're trying to claim that deduction. But more important to remember that you can't deduct the principal portion of your investment property mortgage repayment and only the actual interest that's accruing on the mortgage. So some of the other most common tax deductions on rental investment properties can be the costs associated with actually advertising to get new tenants, any maintenance, repairs, or garden upkeep, any legal fees or property management and agent fees, and also any land tax that might be associated with the property. So remember that there are actually a lot of rules that come around and I suppose legislate these deductions, and the deductions can actually change each year. So you really need to check the latest ATO website for up-to-date information, and I'd also recommend speaking to an accountant who can help you with your personal situation and reduce your tax in accordance with the regulations. The other, I suppose, helpful hint is to try and prepay your bills before the end of the financial year, so before the end of the 30th of June, which will maximize your tax deductions in that financial year. So don't forget to hold on to any of those receipts as well that are relating to those property expenses, just in case you need them.
That's it, guys, and you potentially get quite a lot from that as well. So what about the property investment, property depreciation? Can you claim any tax breaks on the investment property's declining values?
Yeah, sure. So depreciation is one of those expenses you can claim on your tax return that's not, I suppose, a cash flow deduction. And it's really associated with the wear and tear of the property. So specifically after you buy a brand new property or after you or the previous owner completed renovations, improvements, or even installed new appliances. So you basically need to arrange for a depreciation schedule to be able to legally claim the tax deductions for the structural components of the property. And the costs associated with obtaining a depreciation schedule are also tax deductible, and the schedule can help you make even bigger tax savings. Many investors are actually often under the impression that renovations and home improvements are considered automatic tax write-offs, which isn't actually the case or isn't usually the case. For example, if you decided to renovate the kitchen, this improvement won't usually be considered tax deductible until it actually starts to depreciate over the years. And you must inform the ATO on how much you spent on the renovations in order to claim the tax deductions. You may even be able to claim the tax deductions for depreciation on renovations made by the previous owner, which I think is often something that a lot of property owners would be unaware of. And I suppose emphasize the importance of using an accountant that can help you maximize your tax savings. For any initial repairs you make though, you should consider claiming these as capital works rather than an immediate deduction, because by claiming them as capital work deductions or on repairs and improvements, you'll actually save much more in interest over time. However, if you aren't planning on keeping your property for the long term, this might not be your best strategy to use. And claiming tax deductions for your property depreciation can also be complicated. So again, I would emphasize using the services of an accountant to make sure that you get it right while also getting the maximum savings.
Thanks, Sam. It seems like there are a lot of different ways to save on tax. What is also capital gains tax? And can you reduce tax on these?
So capital gains tax or CGT on a property is a tax obligation that's unique to investors. It comes up when you sell your property and make either a capital gain or a loss. If you profit by selling the investment property, also known as a capital gain, you'll likely be subject to CGT. And if you make a capital loss, you won't actually be subject to CGT. So it's often unavoidable, and the rate that you pay will typically be in line with your marginal tax rate, but there are actually ways to reduce it. So just by owning your property for over a year, you'll likely make yourself eligible for a 50% reduction in the CGT. Plus, many of the costs associated with owning the property will offset how much tax you'll be charged. But again, speak to your tax accountant or financial advisor to help you reduce capital gains tax on your investment properties.
Fantastic. That's it, guys. If you do have a question for Sam regarding reducing tax on investment properties, feel free to leave a comment below. And for our viewers who want to know a bit more about how to maximize your cash flow on investment properties, you can also check out our video here, where we will go through all the different approaches to make the most out of your investment properties. Thanks, Sam, again for being here today, and we will see you there next time.